this particular market is the S&P. And if we start from around a year or so ago, you can see that the price was nearer to 4,000, and we're currently just above 5,600. So quite clearly, the trend is up. Also, so you start off firstly with a daily chart. I would then recommend that you look at a weekly chart and probably a monthly chart to understand the long-term trend of a market. The next thing I would put on are moving averages. These can be quite useful if you can't really work out the trend yourself. So, for example, I've got on there a 55 and 200-day moving average, and you can see that even if you took the price off the chart completely and just had the moving averages on there, both moving averages have been moving higher over the past year or so. So again, that is quite clear that the trend is higher. I would then attempt to put on any trend lines. In an up move, you should be trying to put on an uptrend. You should really only be able to put on an uptrend if it connects at least 3 points. So if we connected this point down here from October 2023, we could connect the point that we saw in April 24, and there's a couple of points that we connected in May of 24 as well. So that is a valid trend line. Please note that it is in close proximity currently to where the 55-day or orange moving average currently lies. That's at 5383. So that does suggest, bearing in mind that there's a trend line there and a moving average there, that would be key near-term support for you. So what do I mean by support? It's an area where you would expect to see some kind of buying emerge. And if there is no buying emerging at this point, you'd start to worry about the overall health of the up move. So let's have a look at our weekly charts. And I would also probably add on an RSI or some kind of momentum indicator. So let's move quickly to our weekly chart. Now, this is actually quite interesting because we've got a number of chart factors on this chart that would suggest that we need to start questioning whether the S&P remains in a healthy bull trend. The first of which is that we've got something called a bearish engulfing candlestick pattern. Now, this kind of happens when the body of a down candle encompasses the whole body of the previous up candle when the market has been in a fairly extensive uptrend. So it does suggest that the buying for this market has actually evaporated, and we have seen quite a bit of selling over the past week. I would also point out to you that while the market has been in an up move, the RSI has not been making higher highs. So you've had a higher high on the S&P, but the RSI has charted a lower high, and that does suggest a loss of upside momentum. And again, that would be quite worrying. So what sort of things are you going to now look for? Well, first of all, if you're in a position and you're already long and you're holding positions in this market, you need to start questioning if you need to continue to hold these long positions. You should at the very least be looking at a decent place to put your stop. And if you've been in this market for quite some time, a reasonable place to put your stop would be somewhere below the key short-term support, which, as we discussed, is here. So you need to, I would say, learn to observe what the market is actually doing. So you can see that the market is selling off quite sharply. You can see, for example, that the RSI has, which had been somewhat overbought, is now neutralizing in the short term. But you can also see that the market, longer term, is also losing this upside momentum. Now, if we just scroll back to look at the history, going back for some way, we can see that actually there's not a hell of a lot of support before this 4809 January 2022 high. that does suggest that if a corrective move does take hold, it might be slightly deeper than you would expect to see. So have a look at your longer term charts. Also look at a monthly chart. So let's go look at a monthly chart. Now, the first thing I would say on this particular chart is that the S&P over the longest time essentially mean reverts around its 55-month moving average. Can you see this sort of dark blue line? That is the 55-month moving average, and it more or less mean reverts around this for years, going back absolutely years and years and years. But since the low that we got in 2020, the market has bounced sharply higher towards this high at 48118, sold off and retested the 55-month moving average. That held, and the market has bounced sharply higher again. But can you see how far away the price is currently from this long-term moving average? So for a market that tends to mean revert to this long-term moving average, we are in fact some distance away from it. And that again adds weight to the idea that we may see some kind of corrective phase feature on the market. So to sum up, there are certain things you should do when you look at a market for the first time, in my opinion. The first is use your observational skills. The second is work out what the trend is. The third is work out if you think that trend is likely to continue or if it is likely to be in question. A really good indicator to help you with that are momentum indicators. They will show you signs of overbought and oversold and also divergences. Look at your moving averages. Now, I particularly like the 55 period and the 200 period moving averages. You certainly don't have to use those, but you should use ones that look fairly close to where your market is. So if you're using a moving average which is too far away from where the price is it really going to help you? I don't think so. And if you use a moving average which is permanently crisscrossing the price action, it's giving you too many signals. Again, it's not really useful. I personally find a 55 period and a 200 period work pretty well on most markets, and I tend to use those as defaults for any market action when I'm first looking at a chart. You also need to see if the market's been in an up move for a while, like this particular S&P market. You need to work out where your key near-term support levels are, your key near-term resistance levels. And if you determine that you think that a market move may be in jeopardy and you are actually in that market, you may want to tighten up some stops. So take a look at your charts because they can actually help you with your decision making, and they can help you also mitigate some of the risk. If nothing else, it will help you determine whether you should continue to hold a position or if you should perhaps think about lightening up a position. Thank you very much.